Hello everyone, welcome back to this week's Technical Insights. Global equity markets had a meltdown last week as weaker than anticipated economic data rocked the market, igniting worries that the economy could be falling into a recession. US stocks tanked after the non-farm payroll data in July slowed more than expected, while the unemployment rate rose close to the highest since October 2021. Non-farm payroll data grew just 114,000 last month, slowing from the 179,000 added in June, and below the 185,000 expected by economists. The unemployment rate increased to 4.3% compared to the 4.1% expected by the market. On Thursday, the ISM Manufacturing Index, which is a barometer of factory activity in the US, also came in at a worst 46.8%, lesser than the expected 48.8%. This reading was also far lower than the previous month reading of 48.5%, and this is a big sign of an economic contraction. The initial jobless claim last Thursday also measured the number of people claiming unemployment benefit in the US, rising sharply by 14,000 to 249,000, reaching an almost new yearly high, surpassing the market expectation of 236,000. After the release of this data, the 10-year Treasury yield dropped below the 4% for the first time since February and fell to its lowest point since December last year, as investors flooded into bonds for safety on the fear that the Fed had made a mistake last week by keeping interest rates unchanged. Banking stocks that would suffer the most under a recession were among the notable losers on Friday. Bank of America was down 4.9% and Wells Fargo lost 6.4%. So before we dive deeper, let's have a recap of how the global markets have ended last Friday. Our Singapore Straits Times Index closed lower on Friday, down 38 points or 1.12%. In Asia, Hong Kong Hang Seng Index lost 359 points or 2.08%, while Japan Nikkei 225 suffered the worst fall, falling almost 2,216 points or 5.81%. In the US, the 30 stocks Dow lost 610 points on Friday or 1.15%. The broad index S&P 500 index dropped 100 points or 1.84%. Tech-heavy Nasdaq Composite Index declined the most, losing 417 points or 2.43% as all three US indices ended in the red on Friday. Amazon's second quarter results sparked investors' concern about the big tech valuation levels of AI-related capital spending. The e-commerce giant lost 8.8% after missing Wall Street revenue estimate and issuing a disappointing forecast. Meanwhile, Intel also crashed 26% after announcing weak guidance and layoffs. For the trading week, the Dow declined 852 points or 2.1% to finish at 39,737 points, notching its first weekly loss in 5 consecutive weeks. The S&P 500 lost 112 points or 2.06% for the period to 5,346 points for its third consecutive losing week. Tech-heavy Nasdaq Composite lost 581 points or 3.35% for the week to 16,776 points to become the first among the three major US benchmarks to enter into correction territory, down more than 10% from its record high on the 11th of July. The S&P 500 and the Dow were 5.7% and 3.9% below their all-time high respectively. In Asia, Hong Kong Hang Seng Index lost 75 points or 0.45% on the week to close at 16,945 points. The Hang Seng Tech Index also dropped 58 points or 1.68% for the period to 3,385 points. Both Hong Kong indices suffered a third straight week of losses as persistent deflation pressures in China and Beijing's reluctance to stimulate the economy have also pushed investors to reduce their exposure. Week to date, our STI index lost 45 points or 1.31% to finish at 3,381 points. Seatrium was the biggest loser on Friday as their stock crashed 11.3% or 19 cents to $1.49 to finish at the bottom of the STI table. The offshore and marine specialist on Friday posted a profit of $36 million for the first half of fiscal year 2024, reversing from a loss of the same period a year ago. At the top of the STI index, we see DFI Retail Group as their share price jumped 2.3% or US 4 cents to $1.78. The group behind Cold Storage and 7-Eleven outlets here more than doubled its underlying profit for the 6 months ended June to US 75.6 million as it reported on Thursday. So for this week analysis, let's look at both of these counter on Seatrium and DFI Retail Group. First, let's take a look at Seatrium. We covered Seatrium in the last week video as well. We identified that Seatrium is in a long-term downtrend since the September of last year and could be facing resistance as it's testing the upper bound of the Bollinger Band, which is the white line that you see over here. The 50 days moving average, which is the blue line that you see here at $1.56, would also be a resistance to watch, and we tested this level last week and had a pullback on Friday. Even with the huge drop on Friday of 11.3%, Seatrium share price still managed to hold on to the 20 days moving average in green over here, now at the $1.50 level as a key support level. The recent low on 28th of June at $1.36 is also the current year-to-date low, and that will provide further support to Seatrium share price around the level of $1.50 to $1.36. On the technical indicators, the MACD line has shown significant convergence towards the signal line, now currently near the zero baseline. This indicates a large drop in the uptrend momentum that we saw in the last few weeks. On the RSI, the latest reading on Friday at 46 points has also dropped below the 50-point neutral mark, and is also below the 14 days RSI moving average at the level of 52. This is a sign that uptrend momentum is likely going to be weak going forward. So we will reiterate our view last week, where the 20 days moving average at $1.45 then and the year-to-date low at $1.36 are possible support level in a range-bound formation in Seatrium share price going forward. And for investors looking into getting into Seatrium, the average 12-month target price from analysts covering Seatrium is at $2.60, representing a 70% upside from here. Next, let's take a look at DFI Retail Group. We last talked about DFI on the 24th of June video. We noted that DFI Retail Group is also in a long-term downtrend since the February of last year. Our view then was to continue to look for prominent resistance level like the upper bound of the Bollinger Band previously at $1.96 or the 100 days moving average, which is the amber line that you see here at $1.98, to take a short position towards the year-to-date low on 19th of April at $1.75. Last Wednesday, we managed to hit the $1.75 level again, which is the year-to-date low previously, and have a new year-to-date low at $1.73. On Thursday and Friday, the stock rebounded and tested the 20 days moving average, which is the green line that you see over here at $1.81, before closing the week at $1.78. Fast forward to last week, we saw some changes in the technical indicators. The MACD line starts to converge towards the signal line, and this is an indication that the downtrend momentum that we observed so far is already subsiding, and it's an indication that we may be in a near-term bottom. The latest RSI reading on Friday at 43 points is also a significant improvement from Thursday reading of 35 points, indicating an uptick in uptrend momentum. But the RSI still has not breached the 50-point neutral mark or the 30-point oversold level. So this is an indication that the share price may still be range-bound for now until the RSI tests either levels again. So with the MACD indicator signaling a near-term bottom and the RSI suggesting that a range-bound formation is likely going to be formed going forward, we reiterate our previous view that year-to-date low at $1.75 previously in April and the level of $1.73 last week could be level to accumulate the shares of DFI Retail Group. And the blue line, which is the 50 days moving average at $1.86 and the upper bound of the Bollinger Band at $1.89 are possible resistance level in a range-bound movement going forward. And these are the updates that I have for you this week. If you do find the information useful, do remember to like, share, and subscribe to stay updated with the latest market movement. And I'll see you again next week in the next Technical Insights.